The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and or through separate funds and may change their holdings at any time.
Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome, everyone, to a new episode of This Week in Intelligent Investing. Thanks for joining us. Great to have my co-hosts with me today, Phil Ordway and Elliot Turner. Phil, let's kick it off with you.
Great. Thanks, John. So I wanted to talk about compensation practices today. This came up this week as I was looking at the company here, kind of going through the earnings parade that we're all getting this time of year. And I was looking at a company, and I won't name it. I'm not trying to call it out. I actually think it's a pretty interesting company. I wouldn't say it's good or bad. I don't own it, but I certainly would consider it. I am considering it right now. But what jumped out to me was it's not a tech company either, but the stock compensation levels are just insane. And it's going to continue and potentially even get worse. And so I was kind of arguing about this or debating it with a friend of mine who tried to think, he took the position that it was actually a good thing. So, by the way, I'll back up a little bit. I'll frame the scenario a little bit more. So this is a pretty big company operating in the US. It's got a pretty steady top line business with some competition, but nothing too disruptive on the horizon. Revenue's been growing pretty nicely. I mean, they definitely got a COVID bump, but nothing completely nuts. So they did add some new customers in 2020, but revenues continued to grow and users fell off a little bit in 2021, but nothing too dramatic. And it's got, good margins. I mean, it's got almost a 20% operating margin, more or less, little above that, actually. It's making money. There's well over $1 billion of free cash flow every year going back to 2017. So what stands out then is if you look at the stock compensation they've issued, they started out at $57 million in 2017, $60 million the following year, $99 million, $125 million in 2020, and $98 million last year. This is a company with not a ton of employees, and certainly not a ton of employees that are getting this kind of stock compensation. It's already controlled by a billionaire. And so this is stock compensation that's going to a relatively small selected group of insiders that should already be pretty well motivated. And if they weren't, here's the problem. All of these shares that were issued over the past few years were generally issued at, I'll pull up the exact prices right now, in the 2020, 2019 frame, they would have been issued between $15 and $25 a share. In 2020, it went up closer to $30. Last year, most of the shares would have been issued well over $30 toward $35 a share. The stock today is at 11. The stock today is at less than it was in March of 2020. It's been absolutely annihilated. And so now you've tied the employees' supposed incentives to stock a price that's way underwater, right? And it wasn't like some of it was options, but it wasn't like, oh, this is just a nice cherry on top. This was a meaningful chunk of people's supposed motivation and compensation. So now you've tied them to a sinking stock price, and this kind of gets to what we were talking about, John and Elliot and I, just now before we started recording. Doing your job is hard enough, and investing is hard enough. There are very few CEOs who can emotionally distance themselves between the stock price and the day-to-day operations and what needs to be done. And so I don't care who it is, whether it's the CFO or the executive vice president or whatever, it's really hard for them to sit here and say, ooh, I got millions of dollars of stock compensation at $25 or $30 a share 18 months ago. And they're doing the math on how much that's worth. And they're buying cars and boats and houses and thinking they've got their retirement saved for and whatever. And now all of a sudden the stock's down 60, 70% from its peak. It's down 50% from where you got the shares issued. You owed taxes on it at that level. You're way upside down on this, and it's stressful for them, right? Why wouldn't it have been better to just pay them with cash and let them make their own decision on it? And look, you can have the type of culture where you say, we expect all senior employees to have a significant stock ownership position. And that's that, right? If the company's well run and the culture's good and people want to stay there and work there, they're going to. And if they want to buy the stock, they're going to. I mean, it's not like there's no precedent for this, right? I mean, there are plenty of companies that have done it this way, and a lot of their employees end up very, very wealthy because of it, and they don't suffer all this strife and heartache along the way. But for whatever reason, in the past 5, 10, at least years, it seems like we've had this huge explosion where these people, and it started in tech in Silicon Valley, where it's just like, okay, we're going to pay you in equity because it's kind of free, funny money, right? I mean, we just issue shares and poof, voila, and everybody's happy. And they are happy if the stock goes up forever in a straight line. But when you run into these rough patches, like so many companies are having right now, at least as it pertains to their stock price, you can't separate people from what's happening in the market. And by the way, this has real implications for the company's balance sheet too, because so many companies convince themselves of this completely backwards, upside down math where they issue hundreds of millions of dollars of stock compensation, and then they go and buy it back in the market using after-tax dollars. I mean, forget about the frictional cost of just the transaction itself. It's so inefficient to do it this way when you could actually deduct the compensation instead of buying back the shares in the open market with after-tax dollars. So in this company's case, and by the way, I should add the elephant in the room here is that this company has a ton of leverage on it. So that is not a small issue here as to why this was also extremely risky and a lot like paying people with just straight stock options, because this company has billions of dollars of debt. As of the most recent quarter, the market cap is now down to about $5-6 billion against $27 billion of debt. This is a very, very levered company. So, and it's been levered the whole way. The debt has gone up over the last 3 or 4 years. It's not like this was a deleveraging story where they were getting out in front of it. So even though they've been generating $1 billion plus of free cash flow every year, the debt is quite extreme. And what did they do along the way? Instead of paying down debt, the stock repurchases over the last 4 years, $500 million, $1.6 billion, $4.5 billion in 2020, and 800 and something million last year. So it's just astounding to see $6-7 billion of stock repurchased at what looks like now an absolutely horrible price, right? I mean, the stock's at least 50% below all of those purchases, and debt's gone up, and you've issued $500 million of stock to your employees along the way. I mean, this is just malpractice in the capital allocation world. And I don't understand why so many companies do it. And then you go in and you read the proxy. And again, I argue this until I'm blue in the face with everybody who will listen to me rant and rave about it, that the proxy is the most underutilized document in all of business and finance. It's stunning to me how many people say, oh, I love this, or I'm a deep fundamental analyst and blah, blah, blah. Well, what about this issue you read in the proxy? I mean, there's a very well-known popular company out there that's the stock's done quite well. It's got an online, quote unquote, disruptive business model, but the family that controls it and the conflicts of interest that are laid bare in the proxy, right? I mean, there's the family's not doing anything wrong per se, but it's impossible for me to believe that you would read this proxy and think this is the type of business where I want to be the minority outside shareholder. And I've talked to some of the people that are very public about owning it, and they have 30 and 40% of their portfolio invested in this one company, in this one publicly traded equity, and they haven't even read the proxy. So I just find it stunning that this kind of stuff still happens when the real hard work of business, developing a product and a business that people actually want to use and that can self-sustain and grow over time, it's so hard. I mean, I'm always in awe of what businesses and the people who run them can accomplish over a few years. It's just stunning. And then we get down to this kind of stuff, which should be the, quote unquote, back office blocking and tackling of running the operation. And they just completely fail down and make life harder on themselves. And I'll never understand it. Why this continues to persist. So I want to ask you guys whether I'm being too harsh in this regard. I mean, it's not a black line test for me to invest in a company if they do this well or do this poorly. But when I see it this extreme, it does make me kind of stop and wonder, like, is this thing just going to go completely off the rails because of some relatively minor choice in how they chose to compensate their people and how much they chose to compensate their people? Or do you guys see it differently?
Yeah, I'm going to give you the classic on the one hand, on the other hand here, which is Modest Proposal had tweeted out a study from Empirical on stock performance and stock comp levels. And I think almost never is stock comp the fulcrum in a thesis. Like, you will be right or wrong because of a million other things before the extent and magnitude of stock comp. That said, companies that tend to be cavalier with stock comp in ways that are not just like profligate, but that are that don't truly achieve business objectives, there could be other problems. So maybe you're more likely to be wrong in one of those other ways. And then the other thing I'm thinking about is in this environment where you have a bunch of companies whose and now that so many companies are way off highs, and so many of these companies that are, growthier tech names, which is where you tend to find these rates of stock comp. I think environmentally, almost all of them are just like way underwater on 2, 3, 4 years of grants, 5 years in some cases. What happens to employees? They just saw a big pool of comp effectively evaporate into nothing. Does it incentivize some sort of like carousel of people leaving to somewhere else to get new stock comp at lower levels? Or, what's going to happen to employee retention, happiness? And, that could have ripple effects too, in the competition for like high quality talent. These are people who, are paid well for a reason. Stock comp's a portion of it. And then lastly, I do hate this whole, our buyback program is designed to offset dilution from stock comp, because you're effectively just making explicit in cash flow terms the expense while trying to play games with it all. I think I've said it on the pod before. I wish someone out there, some company out there, would be like, hey, we're just going to pay our employees more and give them an ESOP where they could buy our stock for 20% less than its market price.
Exactly. Right? It's so good. It's so easy too.
Yeah, just make it all explicit, right? Like, it is right. What it is. People who want to own stock should get the right to own stock, and let them buy in for less than others because, hey, they do have skin in the game in a different way. And that is a good alignment. It's
plenty of companies do that. So to be fair, right, plenty of companies do offer that sort of situation, and God bless them, but it doesn't seem like nearly enough compared to the ones that are kind of egregious stock comp abusers.
Yeah, I saw an interesting healthcare company where everyone who could bought the ESOP last week, and I was like, oh, that's really nice to see, where like they're not a big stock comp company, and you see the forms come in, and it's like, oh yeah, everyone bought it. That's like, it warms my heart.
Yeah,
I think it's very different when companies just issue so that people could sell when the time comes. Like, that's just gross. And yet here I am, I'm long some of these companies. So like, who am I to complain that much? But I do believe, that on the one hand, on the other hand, at the end of the day, I don't think it's the fulcrum in what happens here.
Yeah, I agree. You made a good point there. It's not the fulcrum. I'm not, and that's why I phrased the issue the way I did. Like, am I making a mountain out of a molehill with this? But I think the second part of it, on the one hand, on the other hand, it is exactly right, which is that while it's not the fulcrum, it is still important. And I think the correlation between problems here and problems elsewhere, like you said, is high enough for me to be concerned about it. It's not enough for me to make a bright line test out of it, but it is enough for me to really dig in and triple and quadruple check the other issues and assumptions that might be at issue here, because I do think the correlation is high. And one other thing I think that's worth calling out is we've talked, and this one I will name by name, praise specifically here, is Constellation Software up in Canada, which we've talked about a lot before. And I know personally, this is not any sort of investment recommendation because it's outside the purview of that, but I will call them out as generally being in the top 1% of all companies that I've ever looked at in how thoughtful they are about structuring things, right? I mean, there is nothing that is done there just because. And it's stunning to me how many companies have compensation practices that are done just because. Well, that's how our peers do it. That's how it's always been done. That's how our CFO learned to do it when he was a banker. Whatever, just these brain dead excuses, right? Everything that's done at Constellation on this level, whether it pertains to M&A strategy, hurdle rates, capital allocation, employee compensation, every possible thing they do there is done because Mark Leonard and his team have really thought about it and tried to get it right, or tried to get it as close to right as they possibly can. They don't just settle for good enough or because somebody else does it and told them to do it. And so what do they do in this regard? They actually require people to take their cash compensation, which is generally quite low as a base salary, and then, substantial and appropriate for high performers in the cash level. And they require them to take a meaningful portion of that cash compensation and buy the stock in the open market, or at least they used to. I haven't looked in the past year or two, but I remember when I came across this, I thought, that's really interesting. And that's somewhat unusual. And they will be the first to tell you that this is not a silver bullet, because the risk they run there is that the stock price gets too high. And now you've got literally a policy in place that forces your own people to buy the stock at an inflated value, right? If the market were to just inflate the price of Constellation Software in the public market to a level that the company and its own employees thought was too high, the employees would still have to go out and buy it, right? That's not a great solution by any stretch of the imagination. It's probably better than some of the alternatives. I would hold that line. But again, it just points to the fact that there's no easy answers here, but there ought to be some things that you could eliminate, which is the situation I just described, where you just sort of blow out stock compensation because it's free funny money, and then you go buy it back in the market. It's just that drives me nuts.
Well, let me ask you, Phil, just to follow up on that quickly. What exactly is the difference then between awarding restricted stock versus paying in cash but requiring your employees to buy the stock?
Yeah, so there's two important issues. One is, I believe, I should check the numbers before I speak, but I believe the threshold was something like 30% of your cash compensation. So it wasn't all, right? So in the case where you get a base salary and then a huge chunk of your executive compensation is in stock, is in the unnamed company that I described earlier, I think that ratio would be like 70% or 80% of your stock, or 80% of your total compensation would be jammed down your throat in stock, right? In the case of Constellation, I think it's far lower. So you are giving employees a little bit more choice. And from what I gather from talking to people there, over the years, a lot of people have then made the choice to say, okay, well, I have to spend 30% of the cash bonus on stock. I'm actually going to spend 60 or 70 or 80 or 100 or whatever it is. They end up making the choice to make a much bigger investment on their own in the company. So it does give them more choice, which I'm generally in favor of, while tying them to, a meaningful low kind of level, right? They can't go below 30 is my understanding, unless something has changed there. So that to me makes more sense than just issuing people shares. And by the way, when you're issuing shares, like, I've never heard of a company that takes price into consideration, right? At least in the case of Constellation, they're aware of it. And if the stock were to get completely out of line, I think they have a few ideas as to how they'd handle that. The other issue, of course, that's the real elephant in the room is when you're paying people in cash, you've deducted that compensation from your taxable income, and then you pay it to people, and then it's on them to go actually buy the stock. It doesn't benefit the company when you issue the stock and then buy it back with your own after-tax profits and cash flow, right? So that is just completely backwards and ridiculous. And, the numbers aren't always huge inside of a big company, but I mean, for every company and every CFO would try to claim like, oh, we want to be as efficient as possible and every dollar matters. And it's like, well, then why are you doing this, right? So.
Yeah. One thing that I find also interesting, I don't know if this actually happens like this in real life, but to me, it would seem possible where basically, if you have stock comp, the payoff profile could be really skewed. If the stock goes up a ton, employees actually end up making more money than would be needed to retain them.
100%.
But if a stock drops a ton, you may end up needing to issue more stock comp to kind of compensate for the drop and keep those employees. So it doesn't seem like a great deal for the shareholders.
And very cynically, it's a screw job for the shareholders. And very cynically, I mean, it tends to skew very heavily toward the top, right? And so the senior most executives who actually have the ability to influence the policies and the levels and get the board to sign off on all this stuff are the ones that are going to say, oh, we issued a bunch of stock comp at $50 a share, and now the stock's at 12. We should probably revisit this, right? I mean, it's the old, at its most extreme, a good idea taken way too far into illegal territory was the backdating of options, right? I mean, that whole scandal that we all remember, right? But in a more legal way, in a completely legal way, just a very disingenuous and kind of shameless way, lots of companies do that, right? Where they're like, oh, well, we paid ourselves, I paid myself basically $20 million of stock comp, but that was when the stock was at 50 and now it's at 20. So it's not worth, that much anymore. So I should get more. I should get more shares, right? So the dilution works against you as a shareholder, if you're a non-executive shareholder of it. And look, I had this hammered home to me in terms of the incentives of the whole thing. Because let's not forget what this is trying to do. This is trying to incentivize good people to do well on behalf of the company. And in my opinion, it does the opposite of that a lot of times. I have a very close friend who works for a company that went public, it would have been in 2020. And the IPO went very well. And he'd only been at the company a few years. And he was not a C-level executive, but he got some stock options struck at $4 a share, and the IPO went off at 20 and the stock promptly went to 40. So what does he do? What does any normal, reasonable human being does? They start doing the math as to what those stock options are now worth, right? And he's counting his pile of money at $40 a share. Well, guess what happened? The stock went from $40 a share to 20 to 10. And here we are back at 10. So look, he's still way in the money on those options that are struck at 4, trading at 10, and he's going to get, in any sense of the word, a lot of compensation. And he shouldn't be complaining about the absolute dollar amount of compensation, but what's he comparing it to? He's comparing it to the amount of money he would have made at 40, right? More than 4 times what he's going to make now. And so what has this done to his motivation? He's pissed. He's talking about leaving. He's like, I really have lost some faith in management. This place isn't what I thought it was. And I'm like, well, what changed from, 12 months ago when the stock was at 40? Oh, nothing's changed. I just, I saw all this money that I thought I had evaporate. I mean, it's the psychology of misjudgment, right? We've talked about that on this podcast a million times. When you think you have something and then you realize you don't, or when you have something and then it's taken away, it makes people's brains malfunction. It makes their brains turn to mush. And this is a prime example of how this kind of compensation almost sets you up for that failure, right? And I think it's a huge mistake.
Absolutely. Just one other thought on the share repurchase aspect of what you talked about in this case, where the company bought back a ton of stock at much higher prices. To me, I actually like looking at those kinds of companies as potential investments, especially if they have an owner-operator. So there's someone in the management who cares about not wasting money on buybacks. And to kind of think, well, that person might have thought that was a good buy at that price, and now it's like 50+% lower. I like looking at those kinds of situations, but sometimes the share repurchases at the higher level can also just reflect management hubris. I mean, if you think back to the Sears Holdings example, where they bought back a ton of stock, pretty high up there, basically, and then later on, as the company kind of came crashing down, but wasn't really totally down on its knees, there were like several years where Eddie Lampert actually thought he could compete with Amazon with some kind of a Sears digital initiative, and that, to an outsider, someone who's not at the company, it would have seemed kind of ridiculous. But they actually pursued that strategy for several years. So,
right to the very end. Yeah, the Shop My Way thing went right all the way to the bankruptcy, right?
Yeah, I guess. And, so it's not enough that, a company with an owner-operator was buying back shares a lot higher than they're trading now, even though I like looking at those kinds of situations.
Yeah, agreed.
All right, great. Elliot, let's move on to your topic of the week.
All right. So I wanted to revisit something. We started this podcast basically in the early phases of the COVID pandemic. And I'd several times spoken about how I think, some of the COVID winners are truly changed in a better way. And meanwhile, you fast forward a year and a half, and that just looks like a terrible call on my part. And so I wanted to, in part, revisit that. I had spoken about bifurcating the world into winners and losers, and then bifurcating the winners and losers into those that had ephemeral wins or problems, and those that had more permanent inflections or call it impairments. And one of the things I've been surprised about is how the market hasn't approached this with any nuance. And there's no bifurcation at all. Everything's traded as one trade throughout it all. And as we sit here today, what's kind of wild to observe is that the COVID losers that were ephemeral in nature, allegedly, have actually benefited more since the pandemic in the stock market than have the COVID winners. So, like, to give a couple examples, Booking and Live Nation are all up meaningfully more than Netflix is since COVID started. And there are a bunch of COVID winners that are down since their pre-COVID levels. So, like, what's going on here and why is this happening? I don't necessarily want to answer the question of, like, which companies are doing what and for what reasons, but I want to offer two observations that I've been thinking about and then open it up for discussion on, maybe the bigger question, but also these two particular things. I think the first thing that's going on is the market today, I think even more so than in typical times because of COVID, and because of how extreme an event it is, the market over extrapolates trends, especially when the second derivative is changing dramatically in one direction or another. What I mean by that is rapid acceleration in growth rates. The market doesn't know where growth rates are going to accelerate to or settle down, so it just assumes they're going to persist. And then on the flip side, decelerating growth rates, when growth rates decelerate, well, the assumption is, this thing's never going to get back to its pre-COVID growth trend. It's going to go growth, maybe even negative. So on the way up, everything's good. On the way down, everything's bad. And it's, kind of like extrapolate that in perpetuity. And so, right now, when you think about the COVID losers who are ephemeral in nature, their pains were ephemeral, the Bookings and Live Nations. Well, right now you're getting that second derivative acceleration. So the market's just saying, hey, giddy up, second derivative going up. And on the COVID winners, you're getting kind of like what I call a growth hangover, where if you look over the course of 3 years, their growth was consistent with what you'd have expected pre-COVID, if not better. In the true winners' cases, I insist it's meaningfully better. But, growth right now, as of today, for this very present period, as you lap tough comps, is slower than it had been. And the question is, at what rate does it reestablish itself? And so the market's way over extrapolating, assuming these low growth rates post-COVID are going to kind of go on in perpetuity. And then the second thing I'm thinking a lot about is flows matter so much. So I mentioned in my kind of beginning phases of this little rant, the nuance that the market has not approached things with, the lack of nuance. What's happened, I think, is everything's been put in one bucket. And what's become clear to me is that I lacked an appreciation for how certain environments and certain sectors, everything becomes what I'd call one trade. Effectively, what I mean is like very different businesses with very different revenue drivers, with very different growth outlooks, margin outlooks, et cetera, all end up with the exact same chart. And on the way up, you might think you got something specific right about a business, and you very well might have. But the fact is, when they move in a basket, it makes no difference. You are merely in the right place at the right time is something I'm more convinced of about myself. I'm not speaking about other people here. And what's clear is that when flows reverse, they don't just flatline, they go entirely the opposite way. So when something becomes flow driven on the way up, when the flows reverse, you need to find new buyers, and that's very hard to do. So it's really hard to parse out winners and losers. But one of the things I do think is that it's creating a host of great opportunities here, but also a lot of people who are most keen on capitalizing them are in a lot of pain right now. So it's a really interesting setup. It's really interesting to reflect on the over extrapolation that's been going on. And I think it's really important. It's something that a lot of value investors and long-term investors take for granted, how much flows drive things and how much narrative is kind of a corollary of flow, and it goes hand in hand. And you see companies where the narrative is like absolutely nihilistic right now, when the reality is, way different than I think some of these conversations people are having about them. Though, it was obviously too rosy on the way up. So, that too, the narrative over extrapolates with the direction of the second derivative. And, that's something that I've been thinking a lot about, and I figured I'd lay that out here. Eager to hear your guys' thoughts on this as well.
Yeah, I agree. I think it's an important point that the second derivative can really, this is something Ben Graham figured out all those years ago. The second derivative can really swamp the boat, and it can happen quickly, and it can last for months. It can last for a couple of years. So it's something I've become acutely aware of, certainly over my time investing. And I don't know what to do about it because I certainly can't predict it, right? Maybe in my arrogant youth, I would have thought like, ooh, this data point here or this occurrence that I've just noticed is a sign that the second derivative is just flipped. And, I think there are some people out there that can do it. I think Druckenmiller can do it in more than one asset class, which is pretty impressive, but I certainly can't. So it's not something that I even try to do. But when it happens and when you're in the midst of it, so let's take your assumption or your assertion that things are nihilistic in some of these businesses and some of these stock prices now. If that's the case, then I just try to recognize it for what it is. And, this is probably the hardest part of the whole deal, is just then removing myself from that emotionally and psychologically and saying, all right, like this is a bloodbath. We know it's a bloodbath. What am I going to do about it? And is it right or is it wrong? Right? Is this the second derivative just taking over the narrative and making everything crazy, or is the market telling me something that's important? And I tend not to think that the market is always correct. I think it's usually correct. It's often correct, and I just try to find the places where I agree with it. And when you see really extreme fear and greed in the market and the second derivative is really winning the day, those are the times that I get really excited, because that's the best opportunity to go find something that you can act on, right? I wish I had something more reliable to say. I wish I had like a 4-step algorithm that I could write for this, but that's kind of all I can do.
Yeah, I guess I would also just add that, to me, Elliot, as you point out, it doesn't really make sense for COVID losers to be up more than the COVID winners since the start of COVID. We've had basically what has happened in the world over the past 2 years is that the adoption of the internet has skyrocketed for all kinds of use cases. And that's not going back. to where it was before. So, COVID winners have had a material improvement in their businesses. A lot of growth has been pulled forward and will continue, but from a higher base. And COVID losers, on the other hand, kind of had a pause on their businesses for a couple of years. So to me, if it's really true, which it seems to be, at least in a lot of cases, that COVID losers have done better than COVID winners since the start of the pandemic, it's just a sign that Mr. Market might be overreacting the other way at this point. So, I would just take that as a cue to actually go and do some work on some of these companies that have been killed, also in part or because of what you call, the single trade, which
Yeah,
it shouldn't
John,
be.
I'm glad you mentioned the COVID losers that are winning now, because that was a question I was supposed to ask you guys as well. Like, will there be a moment where these companies like Live Nation and Booking similarly face the second derivative problem, right? Like, is the market just doing the same thing and going from one sector to another and doing this?
I'll jump in on that one just because I happen to know a couple of those businesses, and I won't comment too directly at the risk of giving bad advice or any advice, which is not the goal. But I think to your point, there's been this really weird, one of the weirdest things about COVID for me was both the first and second derivative effects, or the first and second level thinking that's been going on. So not only did you have this obvious scenario where, like John accurately described, you had COVID that permanently pulled forward demand for a lot of companies, particularly if they had any sort of online or any sort of virtual component. And he's right. That's obvious that benefited a lot of those companies, and they got labeled COVID winners or whatever. The problem, as a side note, was in a lot of those cases, it pulled forward demand that required a ton of investment at really, really crappy returns on capital. That doesn't create value, that destroys value. So that's a separate topic. But in the case of some of these quote unquote recovery plays or COVID losers that are winners or whatever you want to call them, things like Live Nation. Live Nation is a concert driven business. And at various points along the way, it's traded above where it would have otherwise. And that is interesting because you blew basically 2 years of their business out of the water. And to make that up on a present value basis, you'd have to say that the subsequent recovery in demand and the economics accruing to Live Nation are going to be so much better that they're going to make up for the fact this company just went nowhere for 2 years. And look, maybe that'll prove to be the case. I don't know. But in the case of the airlines, for example, which I know very well, which we've talked about at least 3 or 4 times before on the podcast, for anyone who's missed it, I owned the airlines starting in 2016 and 2017, or I owned 2 airlines anyway, the common stock of them, largely because I thought the financial benefits of the loyalty programs were tremendous. And ironically enough, those more than held up and actually blew away any of the assumptions I would have ever made on them in the COVID crisis. And I thought that more than outweighed, an average, not a below average, but just an average business in terms of the airline itself. But when COVID hit, it was just so obvious to me that the world had permanently changed for them, and not in a good way, right? I don't know how many people are ever going to go back to business travel and go back to the office and all that kind of stuff, but I know that the competitive balance in that industry is fragile enough that this is not going to be good for most airlines. And the math you would have to do to create enough future value to offset the lost value from February of 2020 right through today, and probably through the rest of 2022 and beyond, is so enormous as to just be completely unreasonable. And yet here we are, where the airlines have traded on a per passenger, per aircraft enterprise value levels that are above where they would have traded pre-COVID. And Elliot, I don't know how to explain it to you. It's truly bizarre to me that's been, I guess you could explain it as saying that once we got through calendar March 2020, that the second derivative was positive because things were getting better. Once you go from 100 to 3, and then you go from 3 to 5 and 5 to 7, everything's improving. I don't know. It's truly bizarre to me.
Yeah, it really feels like everything's just moving on rate of change, not fundamental value at all. And
Right.
that's been like mind-boggling to me. It's like fundamentals haven't mattered on the way up or on the way down. And you could try to think like so many of these businesses are way less volatile, even during COVID, than their stock prices have been. And I don't know. I'm having a hard time putting some of these moves in historical context. There are stocks that are moving as if, kind of like .com when there were no fundamentals. And airlines are a really interesting example of this because that's one I was thinking about too. Like there are some of these companies that are above their previous highs are actually, and I was talking on a per share basis. It's even worse than that because there had been some serious dilution and kind of with the airlines, like took on a lot of debt. So in enterprise value terms, it looks even worse. And it's just it's interesting to try to like learn from this and observe and think about like what sort of enduring changes and lessons there will be out of this. But I wonder if there's just like I wonder what's causing all this like hyper affinity for rate of change. Like if that's always been the case, I know it matters a lot. It obviously matters a lot. And I've used my friend's quote in the past, like the market has a hard time with accelerating growth when growth is already fast. And that cuts both ways, but I don't know. Yeah, I'm kind of like left at a loss, more asking a lot of questions than I am having any sort of firm conclusions about anything here.
I mean, I feel like, this question around why does the market pay so much attention to rate of change, or why does a certain, group of investors, which is a huge group, especially a lot of novice investors or, people who are just focused so much on growth. It's part of the education that investors have received in the last few years in terms of market action. You look at stocks that have done the best, like Tesla has been just a story stock. Or, you take a look at the kind of most prominent ETF story out there, ARK, it's all about innovation. And basically, so my, thesis now is that investors, a lot of them just stopped caring about valuation. And when you stop caring about valuation, then what do you have left? I mean, then it is about rate of change and market share gains and who's growing the fastest. Because I always want to calibrate the fundamentals to the valuation. And basically, a company doesn't need to be growing that fast if it's reasonably valued. If it's hugely valued, then yeah, it does need to be growing really fast, or it has to be super clear that it has a very long-term sustainable moat. But when you just throw valuation out of the picture, you just don't have a lot left to hang your hat on. And then you are always looking at what's the quarterly rate of change, the second derivative, the third derivative, whatever you want to do. You can even start looking at it monthly or weekly. I mean, yeah.
Yeah, I think that's a really powerful point. I think it makes total sense too. A lot of people, and it's one of the questions I ask myself: did like too much of the investor class, myself included, learn some of the wrong lessons the last 2 years, right? Sorry, 10 years, not 2 years, where like if you buy something that's high quality and, it doesn't matter exactly what valuation you pay in the beginning, though I insist personally, I've always been sensitive to starting point valuations, especially. But that, down the line, the quality of the business is going to win out. And look at Amazon. They invested without profits. They eventually look how much value they've created. And that was absolutely a critical part of the zeitgeist heading into COVID, and even more so in the, call it the wake of COVID, the immediate wake of COVID. So I think that does make sense. And when fundamentals don't matter on the way up, why should they matter on the way down, right? Like the market doesn't care. It's not exactly what it's going to be looking at because the investor base isn't exactly anchoring to it. And so it's going to be driven more by flows. The other thing I wonder also, though, that I'd add to it is if the proliferation of like data and data feeds and all this alternative access to information has kind of accelerated the amount of fairly sizable, like the pod shops that just focus on kind of kicking things around based on the most recent rate of change that they see. And if there's just a much bigger group of investors out there who are merely flinging around based on like the latest inflection that they could identify. So I wonder if those two forces compound on one another to create this like incredibly wild oscillating environment.
Yeah, look, I don't want to overstate it, although I do agree with pretty much everything that was said here. And flows certainly matter, and the second derivative certainly matters. And it's a confluence of a lot of things, right? Anytime you get a big, crazy result, there's always going to be multiple things pulling in the same direction. And you've had a ton of money go into passive, which is, of course, by definition, momentum driven. You've had this explosion in the gambling culture, at least here in the US. And so I would say that I don't know about like going quite as far to say that fundamentals just don't matter anymore. I think they do, and people are kind of aware of it in the back of their mind. But one thing that does seem to be kind of completely discarded in the mind of a lot of people in this era, the zeitgeist of the moment, is that odds don't matter, right? People are only looking at the results and completely ignoring the odds that they took on to get those results. So they're looking at what happened at AMC and GameStop and Bitcoin and Tesla and all these things that have gone up so dramatically, and ignoring the fact that that was never even remotely close to likely to happen, and that the odds you took on to get there were atrocious, right? Look, I'm not a Tesla hater. I'm not short Tesla. I do have some issues with the corporate behavior there, but it's also done some very impressive things. And so you have to find some way to distance yourself between the impressive, some of the impressive operating results, and the fact that most of the time along the way, the odds that were implied by the publicly available prices that we saw were totally nuts, right? And it still worked out, and good for all those people, I guess. But I mean, I always say to people, like, the number of people that have told me, like, oh, I'm a first time, buyer in the stock market, or I'm a first time gambler on NFL games on my new app that's legal. And they show me, they ask me to look at what they're doing. And I say, would you flip a coin where if you win, you get 40 cents, and if you lose, you pay me $1? Like, that's what you're doing here. Why would this be attractive? But that seems to be kind of the way things go these days in some regard, but I don't think it'll last forever.
Yeah, I think Tesla is such an interesting example too, in proving the zeitgeist, because I'd say, I've followed it with popcorn, not with any like economic interest. And, I've sympathized with both sides, the bulls and bears along the way. And they are way more profitable today than I think anyone, literally anyone, Musk himself included, would have thought possible right now, even just like 5 years ago. And simultaneously, I think they're way higher market cap than anyone, even the bulls, would have thought. Musk twice has called the stock too expensive and wanted to take it private at like 420, right? Thinking, he'd have good returns, but I don't think anyone would have thought that this was like anything within the realm of possibilities. And I do think that conditioned a certain class of people to think in terms of like, what if it all goes right, instead of what are the base rates and what are the most likely paths from here, and what's the skew look like. And the skew definitely inverted the wrong direction at certain points. And I personally, again, I harp on myself, like recognize it in some things. So I didn't think the degree of vulnerability was quite as extreme as it's been. So it's been, something to learn.
Well, this market really has made it extremely hard for buy and hold investors. In a normal market, I think you can buy a great business and hold it for the long term. And of course, you can still do this. But what happens in this kind of market where, things go to the extreme, to the upside as well as the downside, is that you have clients. I mean, most professional investors have open-ended vehicles of some kind of another, and you have clients coming and going. And, just the way that it works out with people's psychology is they tend to come toward the top and leave toward the bottom. And, that I think makes it much harder for the manager's psychology as well, because you obviously want to make money for your clients. And you want to be a buy and hold investor, but it just makes it so much tougher when you have these kinds of swings. And I don't know what the solution is. I guess you do need to then become a little bit more willing to sell and buy and say that this is just too crazy. But then you're kind of potentially foregoing some of those long-term gains, but yeah, it's just really difficult because we do need to act based on what the market is willing to give us, at any given time. Of course, we don't have to act, but you're not going to get like a market price that you want. It's just going to be whatever the market price is.
Yeah, I think you're 100% right that that's the hardest part of this is the psychology, because you want to do well, right, John? And you're right that even if you're only investing for yourself, but especially if you're investing for other people, you feel those weight of expectations, and the weight of those expectations can become overwhelming and swamp out all the logic and reason that you've worked so hard to cultivate over the years. And I don't know quite what the answer is. I mean, look, we don't want to. There's some level of sociopath out there that can just handle this stuff and not care at all what other people think. But the vast majority of people want to do well, and they want to please others, and they want to show good results, and that can work against you. And I don't know what the best way to counteract that is, other than to prepare for it and to be as steely-eyed and stoic as you can possibly be, just knowing that you're always going to go through periods of bad times, and you just have to grit your teeth and get through it, because there's no way to avoid it over the long term. But by the way, I agree that I used to think, when I first learned about investing, it immediately made sense to me that volatility should not be equated with risk, because that just logically is so stupid, right? I mean, if an investment is not worth zero and the price has gone from 10 to 5, the volatility's gone up and now it looks riskier, but you're buying something at 5 instead of 10, how could that possibly be riskier than buying it at a higher price, right? We all understand that, I think. But what I failed to appreciate in my youthful arrogance of those days, that I now totally appreciate, was that the volatility can create its own risk for reasons you just said, right? In a period like this, where you're having some volatility, it can create risk because it convinces you to do dumb things. And that's something that I didn't appreciate enough over the years.
Yeah, all that makes a lot of sense. And it not just could get you to do dumb things, it could get you to not do smart things.
Oh, exactly. Well, that's even worse in some cases, right? Yeah.
Yeah. But one of the questions I'm still like really trying to wrap my head around is like, is this such a unique epic where there are not truly going to be applicable lessons down the line? Or is this just the nature of markets, so where there will be lots of things like this? I see some people comparing it to the dot-com bubble, and I think that's just insane. I think it's nothing like it at all. And that it's, the fundamentals are more, like we've talked about the absence of fundamental analysis, but the fundamentals are more real in a lot of these things. I'd say not just more real, they're real as opposed to like pure hot air. But at the same time, like this is a once in 100-year event that the world is going through. And we've had such a unique response to it, both in terms of how we've lived our lives, like locking down for months, and how how policy's been implemented, like very extreme stuff in all regards. So all that raises a lot of questions. Like what are the right future lessons to take out of this?
Yeah, great point. I guess I wouldn't be that adamant that I don't see parallels between this and the dot-com boom and bust. I think, yeah, there's always differences, and there are a lot of businesses now that are absolutely for real. There also were in the dot-com boom and bust, like Amazon, emerged a great company out of that. There were a lot of silly companies like pets.com. And maybe now, we're going to look back on this in 10 years. Maybe not, I could be totally wrong, but maybe we'll look back and say, all that crypto stuff, that was just ridiculous. Like that stuff, that was so obvious that was worthless. That whole freaking economy around crypto, just completely worthless. I mean, that's what I think will happen. Could be totally wrong, probably will be totally wrong, because what do I know? Like there's billions, trillions of dollars in that. But so, yeah, there could be parallels. We just may not be seeing them right now, but there's definitely a lot of silly business models, like you think of Fubo TV or whatever that's called. I think we talked about that a little bit in the past. That's kind of a ridiculous business model. But yeah, there's also some good ones.
But I'd say, just for anyone who's listening to this down the line, crypto has hung in and has done better since before COVID than just about any COVID winner out there. So that's an interesting one to call out in the moment right now, because I've actually been surprised by that. That's about the only opinion I have to share on crypto, though.
Yeah. Again, I'm probably wrong, and that's fine. But I think, some things probably take longer to prove out, especially something that where you really, how are you going to, what are the fundamentals? If there are literally no fundamentals, it could take a long time because, yeah. Anyway, Phil, any last words?
I certainly don't have anything to add on crypto. I've tried as hard as I can to understand it, and probably still don't at all. But one thing that does jump out to me, right or wrong, is that there are some really smart people involved, and that's the probably only attraction I see to it. And when they try to explain it, I pretty quickly wonder. I mean, one skill that I definitely have is I can kind of tell quickly whether somebody knows what they're talking about or not. And I would say 99% of the people that I've spoken to or read what they've written don't know what they're talking about. They haven't even bothered to read some of the original documents that created the crypto ecosystem. And so that jumps out to me. And then I would say way more than 99% of the people that are involved, 99.9% of the people that are involved don't know what they believe about crypto. And as soon as you raise any sort of valid criticism, because look, everything has a valid criticism. Nothing is perfect. No financial asset, whether it's a speculative trading sardine or whether it's the greatest fundamental business opportunity you've ever seen in your life, everything has flaws and drawbacks. And when you raise some of those legitimate flaws and drawbacks with 99.9% of crypto buyers and supporters, it just devolves into either they just turn back and yell scoreboard, look at how much the price has gone up, or it devolves into ad hominem attacks, right? I mean, I watched the Daily Journal meeting the other day with Charlie Munger, who took a very strident negative opinion on crypto, and everything was just a ad hominem attack against him. So it does strike me that the big proponents of crypto don't seem to have much valid pushback. It just kind of devolves into these arguments that don't pertain to the matter at hand. So I'll leave it at that.
It's interesting you mentioned Munger there, though, because I think one point that would be good to attach to this conversation is he emphasized how they do invest in tech now and how important tech is and how it's not going away. And it's a key part that every investor should be looking at in the landscape at a time when it seems incredibly out of favor.
Yeah, because look, one of the things they've always preached is you have to keep learning, right? You can never stop learning it. And about every 10 years, I was talking about this with somebody yesterday, about every 10 years, the playbook has had to change, right? From nets to just low book value to some activism and control to, good businesses at low prices to good businesses and great businesses at reasonable prices, et cetera, right? Everything has to change. There's no one specific playbook that's going to last for 50 years, even though the principles are by definition going to last for 50 years if they're worthwhile. And so, yeah, it's an obvious outcome that they, even in their 90s, they would figure out a way to make $100 billion off of what's otherwise known as a tech company.
Yeah, and I think with tech, even if you're someone who maybe didn't grow up on tech or thinks he doesn't understand it, I think you can understand the utility of a lot of tech. I mean, take Google Maps. To me, that's the best example. Like, that stuff is so useful compared to what existed before Google Maps. And, if I could see something like that with crypto, it would certainly change my opinion. And so that's, I think, what it comes down to. Like, what utility is something adding to our lives, to the end user? It can't just be, well, get rich quick, you can get rich with this. Well, no. What is the actual utility in a normal person's life who is not a financial speculator? That's the real test of whether a technology or anything else adds value.
Agreed.
All right, guys. Well, thanks so much. Another great discussion. I hope all of you listening enjoyed it as well. We'll talk to you a week from now. Take care.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.